There's a lot going on in this chapter, so I want to take some time to walk you through some of the merchandising journal entries and how we're looking at the process of buying inventory to sell differently from when we're trying to make inventory or sell a service. So to do that, we have to understand the account cost of goods sold. Again, this is an expense type account, so make sure you are aware of that. It would go into your stockholders' equity as an expense account. Therefore, because it is an expense account, that normal balance is a debit and it's going to go on your income statement. The inventory account, we should understand, is an asset account. The normal balance then, therefore, is a debit, but this is going to go on your balance sheet. So when we're looking at merchandising, there's a couple of equations to just understand so that we can then understand the flow of the inventory throughout the process. The first thing we want to understand is how our income statement looks a little bit different now. And we'll get into in just a minute a multi-step income statement, which expands this even further. But what we need to recognize is that our income statement is just not sales or revenue minus expenses. Instead of revenue, we are now calling this sales, because sales is what produces our revenue. We're going to subtract out that cost of goods sold, which will then equal a gross profit. Therefore, it's important we understand that term gross profit. That's what we're making just on the products sold. Then you're going to subtract out all the other operating expenses to come down to your net income or net loss. So make sure you understand that piece of it, how what we record in a merchandising company is just a tad bit different than a service company. Also, the flow of costs is important to know. First, we're going to start with our beginning inventory. We add in all of our cost of goods purchased. And that's going to give us our goods available for sale. That seems common, right? But when we're looking at all of this in equations, it's great to have this equation out in front of you, so when everything gets a little bit more complex, you can bring it down to these simple equations. Another really good piece of information to understand is this cost of goods available for sale. If we subtract out our ending inventory, that's going to equal our cost of goods sold. Therefore, we can also look at that as cost of goods available for sale, subtract out our cost of goods sold, and that's going to give us our ending inventory. We're going to use these three equations not only in this chapter but in chapters to come, so make sure you kind of understand that process. We also want to make sure you understand the difference between periodic and perpetual. So just make sure you look up those terms, define those, and see if you have any questions about them. But I want to really focus on recording these purchases and sales and some new accounts that are going to come into place. First, we have to talk about these freight costs. Freight costs are what it costs to get our merchandise from one point to the other point. And there's terms called FOB shipping point. FOB shipping point tells me who's paying for the inventory, who owns it, and how we're going to account for these charges. So if in our terms of purchase, it is FOB shipping point, the buyer is going to then pay for the shipping, but then as soon as that merchandise is on the truck, the buyer owns it. That's good to know for not only balance sheet purposes, but also for liability and other reasons. So these shipping charges would then go to the inventory account. This is because whatever it's going to take to get that inventory ready for sale is going to go into the cost of the inventory. Therefore, if it is FOB shipping point, again, and we're the seller, we're recording this shipping charges, we're going to debit our inventory, credit our cash. You'll notice our inventory in units technically isn't increasing. We're just increasing the cost of that inventory. Now let's look at the other piece of it. If it's FOB destination. If it's FOB destination, that means that the seller is going to pay for the shipping charges. The seller is responsible and owns those items while they're in transit. And then these charges are going to go to an account called freight out. This is an expense account. And it's just the account that we keep these charges in. So this is incorrect on here. So if it is FOB destination, what does that look like? What does that journal entry look like? Remember, freight out is an expense account. If I'm going to increase that, I debit it. So I'm going to debit freight out. I'll credit my cash for that $400. Now, we don't always keep everything we buy, right? So we need to understand how to record these returns and allowances. We all understand the term return, and I think that's great. I think we've all done that. But let's also understand the term allowance. So an allowance is like getting a credit. It's a credit for your purchase, but you don't have to return those items. So for unreturned inventory. So let's say you bought a bunch of pens and you wanted blue pens. They sent you a whole box. They were red pens. They're going to tell you, you can keep them. I'll take $50 off the charge. That's what an allowance is. So you keep the merchandise, you just pay less for it. A purchase discount, on the other hand, is a tool used to increase how fast somebody is paying for their merchandise. So in your purchase agreement, you'll see terms such as this, 210 net 30. That first number is going to be the percentage of discount you get. It doesn't always have to be a 2, but that's the first number you're going to see is the percentage discount. The second number you see is the number of days you get to get that discount. So if you pay here within 10 days, you'll get a 2% discount. The N means net, or otherwise, the full amount is going to be due in 30 days. So that last number is your final due date. So what does all of that look like? When the buyer purchases some inventory, we're not sure if they're going to take those terms yet, or if we are. So what we want to record is that we purchased our inventory and we have to pay for it. for the full amount, because we're not sure yet whether we're going to pay early or not. So then if we do pay within those 10 days, we're going to debit that account payable, and that's for the full amount, because we need that account to zero out. We're going to credit our cash and credit our inventory, because the amount we pay for the inventory is going to be less. So our inventory amount that we're crediting is that percentage times your accounts payable amount, or here 2,000 times 2%, which I think is 40. Your cash amount, remember debits have to equal credits. So we're just going to figure out what our cash has to be, which is 1960, or 2,000 minus 40. Now, if we make this payment but we do it after the discount date, nothing's going to change. We're going to debit that account payable and credit cash for the full amount. But what does this all look like from the seller standpoint? There's two new accounts we really have to understand: sales returns and allowances and sales discounts. These accounts, both of them, are called contra revenue account. Remember, when we talked about accumulated depreciation, that was a contra asset account because it attached itself to the asset but had that opposite balance. These are the same thing. So these are revenue accounts, but their normal balance, because they're contra accounts, is going to be a debit. And because they are revenue accounts, you're going to find these on the income statement. So let's look at what happens when, on the seller side, when we make a sale. So we also have to record not only the sale, but also the cost. The cost of the inventory here is $1,500. Whoops. That should be on your copy. So anytime there's a sale, it takes two journal entry. The first one, record the sale. The second one, record the cost of goods sold. So we need to record the sale. We're going to debit that account receivable and credit our sales. But that sale had to come from our inventory. So we need to make sure we show that that inventory is no longer available and that there's an expense related to that. So that's when we're going to debit the cost of goods sold and credit our, credit our inventory account for the cost. The cost here is $1,500. So every time you make a sale, just make sure you get both of those journal entries in. Next is recording the receipt of payment if they made it within the discount period. Again, just because we're moving here, it was a $2,000 sale. That discount was 2%, so that's $40. But remember, we're recording from the seller standpoint, so we're going to receive the cash. We're going to offer them a sales discount. That's a normal debit. And then we have to show that they're paying off their entire account receivable. So I'll start here with that credit was full $2,000, which would wipe out that account, make it 0. My sales discount is that 2%, so that's the 40, and the cash is the difference. Next, what does it look like if they made it after the discount period? Again, same thing, account receivable. The only difference is there's no discount. The purchase return, again, we need to add here that the inventory, the cost of goods is $375. Because whenever we have a sales return, then we have to not only kind of put that inventory back on the shelf, but we also have to reverse that sale. So if we come back up here and look at these two journal entries here, what we want to do is bring them down here and reverse it. So first of all, we'll go ahead and reverse that sale using that contra account sales returns and allowances. And then we're going to go ahead and credit that account receivable because they don't owe us that money anymore. And that's for the full amount. And then the second part of that is to record putting that inventory back on the shelf. So we're increasing our inventory. The cost of that inventory was $375. And then we're going to then decrease the amount of cost of goods sold. That shows that return. Just a couple other things when we're looking at, when we're talking about inventory, things happen. If they reduce the inventory, at the end of the year you go and you count it and it's not all there. You have to make those adjustments. So make sure you look that up, and just as a review, fill in these closing entries, because remember, sales revenue, sales returns and allowances, and sales discount, all revenue accounts, which would have to be closed, as well as the expense account, cost of goods sold. So what is their normal balance and what would they be closed with? So you're familiar with that. The last step in understanding the merchandising income statement is to really break it down. And this is why we keep our sales and our sales discounts and sales returns all separate, because we want to make sure we understand where everything's coming from and what's happening. So this net sales is coming from our sales minus our sales discount minus our sales returns and allowances. So that's going to equal my net sales. Your next section in your income statement would be to take that net sales, subtract out that cost of goods sold, and that's going to equal your gross profit. Again, your gross profit is just telling you how much you're making just on that inventory you sold. From gross profit, we're going to subtract out our operating expenses to give us our income from operations. And a lot of your test questions are going to ask you, what is my gross profit? So it's good to know what goes into each of these individual items. And the final section of your multi-step income statement is these non-operating activities. So we're going to take our income from operations, we're going to add any other revenue or gains, and we're going to subtract any other expenses or losses. Now that may seem confusing because why wouldn't they be up in our operating expenses? It's because these types of expenses are not used to operate the business. So other revenue and gain might include interest revenue or gains on sale of equipment, of property, plant, and equipment. Some other expenses might include interest expense, or maybe a casualty loss if there was like a fire or a flood. That would all go into these other expenses. So I know there's a lot in this chapter. Take it one step at a time, especially this multi-step income statement, and hopefully it'll make a little bit more sense. But if not, please email me with questions.